Welcome to this episode number 97 of Your Next Trade, called today New Leaders. So, if we look at the overall market, stocks have been really struggling since the start of the year. As traders, portfolio managers, we try to identify at any point in time, what are going to be the good longs, the stocks that are going to be outperforming the market, and vice versa, being shorts the stocks that where we think they're going to be underperforming. One of the ways to look at it is obviously through the price action, and trying to find, at any point in time, what are the sectors, what are the industries that are doing well. So if you look at something here, this is the chart that I'm sharing every single week with the trading community on Discord, which is about looking at the 11 sectors of the S&P versus the S&P 500. And what is pretty clear over the last 12 months, and even more over the last 3 months, is the market is struggling to find new leaders. So the NVIDIA that we had 12 months ago actually died away over the last 6 months. If you look at technology here versus the S&P, as we can see, it peaked last year, and since then it has been on the downtrend. Probably the only sector that is still okay is financials, trading on the up. But if you look at the absolute price action of those names, we are talking Goldman Sachs, JP Morgan, Bank of America, they have been struggling a bit. So pretty clear that the market is in a downtrend so far. Why? Because we don't have any new leaders. So the target, and if we want to see actually the market breadth and the market really going up again, we'll have to find those new sectors, those new leaders that will be pushing the market higher. So that translates into the year-to-date asset performances of the S&P down 5%, Nasdaq now down double digit, Russell 10% almost. The only place that is doing okay is Europe. So Europe is up due to the German bazooka. But really interesting is the dollar. So dollar is down 4 to 5% versus most currencies. What has been pretty clear from day one from the Trump administration, on one hand, they were saying, we want to have a strong dollar. But the reality is they are very happy to see the weakening of the US dollar, the same as 2017. Why? Because it's going to be helping the exports of US companies. If you look at gold, 18%, we're going to see later with the technical analysis making new highs after new highs. We had two very strong days on Thursday and Friday, and copper doing very well as well. So there's a bit of an arbitrage between the New York listing and the London listing due to tariffs, and there is a divergence between the two where US is outperforming Europe. So what about the week-to-date asset performance? This is a week off for stocks. We are roughly down 1 to 2% for stocks. Dollar trading sideways, and commodities, real assets doing pretty well. Gold, as I said, up 2%. So I'm interested into the year-to-date industry performance. So right-hand side, you do have like gold, silver, gold miners. That's normal when gold is up in double digit. Other end of the spectrum, we do have like airlines, transportation, software, retail, cloud. So what does that mean? That means the cyclicals have been really struggling, and the ex-leaders, we are talking technology, semiconductors, have been underperforming. So the S&P here will be there. So that's the sectors that are underperforming the market, and overall this is the ones that are doing better. So on a week-to-date industry performance, this is a week off. Really, the ex-leaders, the NVIDIA of this world, have been struggling with semiconductors down roughly 6%, cloud, digital infrastructure, and on the other hand, as I said, same picture as the year-to-date. So this week was just the reflection of what we had so far for the year. Same sectors that are doing badly or pretty good on the week. So week to date, IT really the underperformer. We are back to what we had so far. We had a week of relief last week, but other than that, this is the same story. Consumer staples, guess what? They are the defensives, and they have been doing their job. Energy a bit outperforming the market, but not that much. So What about the rates? How they have been doing? Now we are still at 425 on the US 10 year. So this is more or less the range, as I said last week, between 4.1 and 4.7. We had quite a lot of bond supply into this week, so that explains as well why the bonds, the yields were pretty high, and we saw actually coming down on Friday due to the risk off. 10 years versus the 2.035, more or less the same. I'm interested into the Fed funds rates. So looking at what is priced by the market going into the end of the year, we are roughly at 70 bips, 0.7%, which is 2.5 cut versus the until the end of this year. If you listen to most Fed speakers, they will tell you that for this year they are expecting 2 cuts, but now the market is saying, oh, the odds of a recession are a bit higher than they were 2 or 3 months ago. So that means instead of pricing 2 cuts, we are pricing 2.5 to 3 cuts. But more or less what we see is the big change from the start of the year, where we are expecting the Fed to be more accommodative due to the risk of a recession. So really the question for all of us is recession or no recession. If we get a recession, as we said in the past, we are talking, probably the market stocks going down 30% plus. If there is no recession, this is your normal drawdown, roughly 10%. And we have, signals from soft data that are telling us that really the economy is slowing. Hard data are still doing fine, but hard data most of the time are going to be a bit late. So if you look at the leading indicators, you do have different pictures between ISM services doing okay and some others that are not doing well, like the construction, where you do have like a slowdown. So really the expectations from these 2 to 3% GDP growth that we had in November, December 2024, where I said clearly these expectations have been way too high, have been lowered. We are probably coming into for Q1 1 to 1.5%, but really the question is not Q1 now, is Q2 and Q3. What about volatility? So now we are 21% plus on the S&P 500 30 days. The 9 days as well is pretty high, or should I say higher than what it was in the past. More uncertainty means higher volatility. So this is what we have these days. We have a higher volatility. We had really ranges of on a daily, weekly and monthly that have been going up. If you look at the weekly straddle that we like to flag every single week, we are now into the 2.5% move, where not so long ago it was more into the 1% to 1.5%. So let's chart now and into the charts and look, starting with I would like to be starting with the S&P 500, but the chart with the Nasdaq is more or less the same. So this is not a fake. We are going lower now. We have decent volume. The market has been really struggling to hold this trend. This is for the S&P. Since we made almost this, it's a small double top, but we have been coming lower. And as you can see, we have been coming lower in higher than average volume, which is not a good sign when it goes down. This is the same for the Nasdaq, where the volume recently in January, February have been higher than usual. So what does it tell you? We saw flows of first, as you remember or not, hedge funds and funds degrossing their exposure. So when you've been running a big book, like let's say 500% long versus 500% short, it goes against you. You go and you reduce this gross exposure to 400, 300. But now we are seeing flows, sellers, and this is what is making this market going lower. Despite retail being bullish probably 2 weeks ago, now the flows have been coming down. I'm interested into copper. So copper has been making new highs. So this one is not the good one. I should be putting another contract, but literally it has been on a tear over the last 3 months. We had a really big move of 15%. That will be the same move as we have for the gold. So gold at 3,085. I'm interested into the last couple of days, as you can see, very, very strong. So when gold is seeing that many flows coming, that tells you that there is a lot of uncertainty in the market. Another chart that I would like to flag, so this is the where we started this session, looking at technology, XLK, which is the ETF for technology versus the S&P. So what is it telling you? That we peaked around summer last year, and since then we have been struggling. If you look at the price action since the start of the year, that has been really underperforming the market. We are talking 7-8%. But really, I don't know if you remember, but DeepSeek story around mid-January, when the market really didn't like it that much, started to sell off. Some people were saying this is a one-off, Nvidia is still doing very well. No, that means there is degrossing. That means people are paying, 40, 50 times earnings are paying less. And that has been the trend so far. So don't go against the trend. The trend is telling you we are going lower for the time being. And as long as we don't have a catalyst of telling us that this is not a recession, this is the way forward. So looking at this week, starting with the S&P 500, you remember or not that over the last 2 to 3 weeks, I flagged the JP Morgan collar, that is where one of the position is a put at 5,560, and this position is for the end of the month. That means on Monday. So what is happening is the market is naturally targeting and this magnet of 5,500, 600. We are going there. There is no magic in that. It's just that the position is way too big. So we closed on Friday 20 points above, but literally that was the direction. So no surprise that here, this is something that I flagged over the last 2 to 3 weeks. What you need to understand as a trader, as a portfolio manager, is where are the big positions, and we are mostly driven by options. And the strike that we flagged is pretty clear. This is where the market has been heading. So we had a bit of macro with the flash PMIs. We got the PCE. So what about PCE inflation? So this is the core PCE. We saw that that was on Friday, that inflation core PCE was a bit higher than expected. We are talking almost 0.4% month on month. And we had some other signs from the University of Michigan about the expectations of inflation that this is coming down. You can argue this is the Democrats versus the Republicans, but that tells you as well that there is uncertainty, and probably that the consumer, US consumers that were doing so well until not so long ago, now there are questions, and if they are not buying anymore, then that means, or buying less, that means the GDP is going into a problem. So here as well, what I want to flag is the wealth effect. So we clearly know that the stocks have been on a tear over the last 15 years, that over the last couple of years in 2023 and 2024, they have been up 25% each year. What it helps, it's obviously for the US consumer, for the US families, the household, to be doing very well if they own stocks. And as you can see into that chart, that is a chart from Bank of America, is 1968, US households were holding 28% of equities versus their total financial assets in 2024, and most recently 29%. So in reality, US households are very long the equity market, the stock market, and that means, by definition, when your 401 is going up due to the market going up, it's all good. And vice versa, when the market is down 5, 10, 15%, you're running, this is the opposite of the wealth effect. So there is a question now, how long, we're going to see this market going down, and how much is going to be affecting the US consumer. If you look over the last two times, which was 1968 and 2000, where it was the peak almost, and when we went into some recession, the market really struggled in the next 10 years. So it tells you that the wealth effect might be over, and that means the US economy going forward is not going to be benefiting as much as it was in the past. So what about the catalyst for the next few days, looking into end of the month? So 31st of March, end of the month, end of the quarter. That is important, as we flagged, because of this positioning of these big hedge funds and these big funds, where you do have like some rolling of existing positions. So you should expect on Monday, in the last hours of the trading, some funny moves due to this 55-60 put and the rolling of those positions, because they need to move those positions from March into April and to June. So we do have like some fundamentals, some economic numbers, macro numbers, with the manufacturing PMIs on Tuesday, and on Thursday the service PMIs and ISM. So this is for your leading indicators. We do know that services have been doing okay, manufacturing not so well. Friday we do have like the job numbers with the NFP, so important numbers. Most recently there has been, as always, a lot of volatility around the NFP numbers. We have been trending around the 150,000. If we see lower numbers, so that means really the economy is slowing, so something to be looking at. We do have as well Fed Powell talking on the same day, so very important on economic outlook. So far he has been pretty clear on saying we are fine, the economy is doing okay. If we do have like some bad numbers, then that could be the rhetoric could be a bit different. We do have like on Wednesday the Tesla Q1 deliveries. It's not only noise, but Tesla really, due to this to the big move that the stock had, and as well some of waiting. This is something to be looking at on Wednesday. Sorry. Finally, question: recession versus no recession. We do have like flows here, so this is something from Goldman Sachs into the infotech flows, and as you can see here, I didn't flag it perfectly, but we saw some really outflows coming into that space, not only into that space, but some other sectors where we saw those outflows. When you do have like outflows, mechanically by definition, it makes the market going lower. So market for the time being is still in a selling mode, no hedging so far, but really every single week we see new selling. Finally, S&P weekly straddle plus minus 2.5%, so this is much higher than it was a couple of months ago. So this is your range that is priced by option for the week. So this is roughly it for this week. The question is all about, recession of no recession. So far for Q1, we are talking 1%, 1.5%, despite what the Atlanta Fed is saying. But question is for Q2, Q3, we do have like the tariffs coming on Wednesday. We already got the auto tariffs that were announced this week that has an impact. That's going to be impacting most industries, and that is the unfortunately or fortunately, you do as a trader, it's the reading the tape, reading the news, and it's affecting the market. But overall, what we see as well is, with all this noise, and the market is going lower. If you look at the chart for this week, it was pretty clear that it's almost like a selling order for the whole week, with the magnet, as we said, at 55.60. So if you got any question of what we do, how to go into having the same process as I do have, you could look at the 4x4 video series. We do the mentoring as well, so this is one-on-one session on Zoom. We do 12 sessions. I do it, Etienne is doing it. So this is to help you create and run your own portfolio. Any questions, you can send me an email, or you can join us on Discord for the trading community. So this is it for me for this week. Have a good trading week. Bye bye.